I received a phone call from a good friend of mine who spent the last 7 years in Australia. He's moving back to the United States, but he's concerned about dollar debasement and where to put his money. And it got me thinking. We'll talk about that today on Open Interest. So late last week, as many of you will undoubtedly have observed, gold and silver got absolutely slammed. I had written an article which got published on CNBC Pro on Monday, suggesting that for those who were long silver, they could consider, whether it was via SLV or maybe via futures or whatever else, that they could collar it because silver had positive skew, meaning that the upside calls were trading at a significant premium to the downside puts. And it was possible to go out to March, buy a 10% out of the money put, financed completely by the sale of a 20% out of the money call on silver. On Friday, after silver fell about 30%, I suggested that it might be time to cover that short call and roll down the put, which was by that time very much in the money, and essentially sort of do a little bit of a reset. The phone call that I received on Friday was kind of related to this because my friend, actually somebody I've known since college, former New York City lawyer who, along with his wife and kids, moved to Australia for work 7 years ago. He's very likely coming back to the States, but is a little bit concerned because he has watched steadily as the value of the U.S. dollar relative to the Australian dollar has actually gone down in recent months. And so he was thinking, and he has positions in the S&P 500. I don't think he had much by way of bullion or anything like that, or speculations in GLD, SLV, or precious metal futures. But he was saying, should I sell my S&P 500 investments, which he has in a variety of accounts? And it got me thinking that there seems to be this perception after Warsh was nominated for the Fed, and he is somebody who has previously discussed pairing the balance sheet, the Fed's balance sheet, that was going to hit the metals, which it did, and it was going to hit risk assets like stocks. And I thought maybe some longer-term context made some sense. And so to that end, I actually constructed a couple charts, and I have a couple others. Let me see if I can pull them up here. So let's start with this one, which I think is quite important. This is the Fed's own reckoning of the value of the U.S. dollar in terms of its purchasing power since the creation of the Federal Reserve. And barring one sort of area of exception in here in the 1920s, what we can see is that the value of the U.S. dollar has eroded considerably. What does considerably mean? Well, if we start at, we'll call it 1,000, it is now at 30, so we'll say that it has eroded by about 90, by the Fed's reckoning, the value of the dollar has declined by 97% since the Fed was created. Their own data. One wonders why that they would want to have that data up there. Doesn't exactly make folks all that enthusiastic about one of their core responsibilities, which is maintaining some stability in the currency. Be that as it may, some examples of this would include things like the purchase of homes. This right here represents the average home price since, I think, about 1960. Let's see when this one starts. 1963. I also have the median price, also, I believe, from 1963 as well. Yep, there it is. And so what I decided was, well, what if we took a look at how effective gold has been. I'm going to leave silver out of it for the moment. How effective gold has been as a store of value. And what this first chart represents on the top here, which I can probably blow up a little bit, and I will try to do that. So what this represents is basically the purchasing price of the median U.S. home. In this case, I was using the median in ounces of gold. And you can see that there was a period here during the late 80s and in the 1990s when it took a lot more gold to buy a house. This was an interesting time, of course, because going into the tail end of the 1990s, we actually started to run a balanced fiscal budget. Now, that isn't the only reason, but basically the dollar strengthened against a lot of other currencies also. Some may remember in the 1980s that the dollar was relatively strong, and also gold was essentially moribund for much of that time. As another way to look at this, I also took a look at pricing the median U.S. house in, we'll call it shares of the S&P 500, also going back to 1963. And what we can see here is that if you were, say, saving to buy a house, would you be better off putting your money into gold, or would you be better off putting your money into the S&P? Now, at the beginning of this period, it took, we're going to say, 269 shares or units of the S&P 500 to buy a house. And by now, that number is 73. Again, we'll go back to take a look at gold. So at the beginning of 1963, roundabout, we'll call it 300 ounces of gold to buy a house. It's down to 131. If you were looking at it on the S&P's side, 270 shares of the S&P in effect to buy the median house. And now it is down to what was that number? 73. So it would appear that if you're trying to decide whether you should put your money into gold or into high-quality companies. Now, this is the S&P 500, so you're going to have the good with the bad, but the good news is that better companies are going to find their way up to the top. And so the best companies in the 1980s were not the same ones necessarily that you saw in the late 1990s or more recently. The better they perform, the more heavily they will be weighted. The worse they perform, the lower they'll be weighted until they eventually fall out of the index, which has happened to plenty of companies. But it was a point I was trying to make. And if you're wondering one of the reasons why, once upon a time, of course, before when gold was actually the way that money, what we use for money, you could deposit gold in the bank and you could maybe earn some interest on it. You can no longer deposit gold into the bank and earn interest on it. So although you are storing value, you're not earning anything on it. Whereas with the S&P, you're effectively buying some pool of real assets and of legitimate businesses, and assuming that their return on invested capital is decent over the course of time, then you actually should outperform just simply storing it because your investment should actually be making some money. Now, I would argue that if someone looked at a chart of the S&P over the course of the last 60 plus years, and they would say, well, this is just a spectacular investment. And it has been a very good investment. But when you sort of take a look at the purchasing power of those units in the S&P, you will realize that in real terms, that investment hasn't been quite as good as it might look if we're just looking at it on a notional basis. But my general sense of things is that for anybody out there who's saying to themselves, well, I am concerned about this dollar debasement issue, I am concerned about the next appointee to the Fed, and I'm concerned about the price of stocks generally. Are they overpriced? Depending on one's time horizon, of course, you should always keep enough of cash around to handle your near-term needs. But the fact is that you're probably going to do just fine if you are invested in the S&P 500 in general. I like an allocation to gold. One of the reasons I like an allocation to gold, but it shouldn't be too large, is that as you can see here, they don't always correlate. And that's kind of a nice feature in a portfolio, is to have assets that are not highly correlated with one another. Sometimes they are correlated, and they have been more correlated recently, but that would be something to think about. Okay. So with that, and I also should point out very quickly that because I'm doing fast money today, we're going to have to keep this one quick, which is the reason I'm going to move right along and start taking some questions. So Jim Howard says, Mike, your perhaps bullish outlook on a trade for BE using your common process. Also hope you explore some filtering on unusual whales to compare with Bloomberg's system. Thanks. Well, you are right. I should use unusual whales because, of course, some of you will have access to that. Probably more of you have access to unusual whales, and it's certainly more affordable than Bloomberg is. I'm not going to do that today because of our limited time, but let's go ahead and take a look at BE. Maybe we can get to that one on Wednesday. So BE, for those that don't know, that is Bloom Energy. So let's start with the good news. And the good news is going to be seen right here. And that is the rate of top line growth. So if we take a look at full year 2021 revenues, less than $1 billion. We're going to be getting numbers, I assume, from them soon, which will tell us what full year 25 was. When are they going to be reporting? It's going to be in 2 days, 3 days. So they're going to be reporting on the 5th. And we have some exceptional top-line growth. We like that. That's positive. The other thing we like to look for is expanding margins. So in terms of gross adjusted margins, those have been expanding. That is also good. Adjusted net income margins, those have been expanding, which is also good. In fact, it would need to be the case because, of course, this is we're talking about a new business here, so actually they weren't making any money originally. We like to see the cash flow growing. It was negative free cash flow for a while, got to positive free cash flow. I think that is clearly critical, although this is where we start to run into a little bit of a problem, and that is that the free cash flow for full year 2025 relative to the enterprise value of the business at almost $38 billion is effectively de minimis. So, we're not really looking at this as a free cash flow situation. And we can also see that the earnings multiple here. So again, this is a $37 to $38 billion business, whether you're looking at market cap or enterprise value, for a business that is expected, when they report this week, to have made about $90 million adjusted for the full year. This is a pretty heady valuation. But the growth is there. This is probably not a name that would have shown up on... It wouldn't have shown up on my screen. And it wouldn't have shown up on my screen simply because the free cash flow yield is too low. So I, like to see, free cash flow yield of, call it 2% or better. But that's not a knock on, betting on growth companies. It just happens to be part of my process that it's a little bit more conservative. So I'm going to tend to be looking at companies that are going to be a little bit less speculative in nature. So why don't we now then take a quick peek at what the technicals have to say for us and see. It certainly looks like it's, that's pretty uniform. So all of the best performing technical indicators remain bullish, despite the fact that the stock has, one thing I tend to look at is this, which is the distance between, I'm going to actually get rid of these other moving averages. But I do like to compare the share price to the 50-day moving average, because when that gets to be really a little extended, sometimes that can be, indicative that it could be due for a pullback. If anything, it does feel to me like it might be a little bit stretched. Another way we can look at that is taking a look at the RSI. We'll see what that has to say. Bumping along in here. But as you can see from earlier times this year, all in here, it existed well above 70 on the RSI for a good portion of that time. So, look, I mean, this is a little bit of a, if this is the kind of thing that you're interested in, from a fundamental standpoint, if we did not think about valuation, I like what I see, which is very good top-line growth, expanding margins. It's moving into a positive free cash flow scenario. To my eye, it feels a bit stretched, though. But again, bear in mind that these are the kinds of names that would be less likely to appear in my portfolio just because of their highly speculative nature. So I hope that helps you, Jim. Okay, Alex, gold and silver dropped significantly, dragging down Bitcoin. What to expect now from GLD, SLV, and MSTR? MSTR is reporting this week. Yeah, it's interesting with respect to strategy. I don't think about strategy too much in terms of their operating business, although arguably the thing that most people would be interested in hearing from them is, are they going to have to sell any of their holdings? And would they consider it for the nominal bond coupons that they do have to pay? Some of them are zeros, of course. And would they ever consider suspending the divs on the preferreds? This is kind of the routine question that they get. So I'm not that concerned about the results. We'll hear what they have to say about those latter questions. Let's take a look at Bitcoin first, because to me, and I've said this many times, that I thought that 74.4 fib was in play, which we're right. You can see. I mean, look at this. I mean, it's right on there. So think about that for a minute, and I'll just show two other sort of numbers that I'm kind of looking at from a technical level with respect to Bitcoin. So this was kind of what I thought was very much in play. So we have achieved that, and it seems to have bounced off of it for now. That's the good news. What is the bad news? Two other. So I'm going to go just refresh this exact same one, and we're going to take a look at the 5-year fib, which would be actually down here. 70,800. And that happens, as you can see, well, it doesn't happen. I mean, it's not a coincidence. That is the level from whence it broke out when it did so in late 2024. So I think this is another critical level. And the final critical level is going to be down around here, not just because that happens to be a Fibonacci retracement, but also because that works out to be the 200-week moving average. So let me see if I can pull this up really quickly. Just put the 10-year in here. There. So you can see that same level also is the 200-week. And you can see that in many times in the past, when it's had these big run-ups, went there on this occasion after a big run-up, this occasion after a big run-up. On this occasion, it actually violated it. And so, I think that also seems like a, another level where it could potentially go. So, again, just to hit on these critical levels, 74.4 1-year Fibonacci retracement and 70.8. I'm talking about Bitcoin proper in thousands, right? So 70,800. And then around 58,000, that's the 200-week and also that longer-term fib right there. So this happens to be, based on what I see, the levels to which it has returned on more than one occasion. So I think that all of those are potentially in play. So just worth considering there. But I do think that I would consider adding right in here. Now let's take a quick peek actually at strategy, because as I previously pointed out, when people are taking a look at the value, so let's just use 70,800 and 651,000. So this right here is essentially priced 1-to-1 at that level from whence it broke out in late 2024. 651,000-ish Bitcoin at 70,800 gets you to about 46.3. And so that's the only reason why, as you look ahead to their earnings, provided that they say, okay, well, we don't think we're going to need, and I'm not sure that that's necessarily true because it doesn't look like they have a huge amount of cash on hand, that they would not have to sell or do some other kind of capital raise. And I don't know that now would be an attractive time for them to raise because the company is not trading at a premium. It's not like they don't have anything to sell necessarily. So before, when they were trading at a premium to their holdings, material premium to their holdings, then you could issue stock. If there was high volatility and you were getting, really out of the money strikes for selling zero converts, then you could do that. And it was going to be accretive to shareholders. At this point, just because of where the equity is trading, it's not going to be accretive. So, as is always the case, typically when businesses most need to raise capital potentially for short-term cash purposes, it doesn't tend to be available to them at the most favorable price. And I would say that that's the case here. So I don't really see them doing a whole lot of raises. So we'll just say that. But I do think that, this is beginning to get interesting. Oh, one other point that I would quickly make. So Hedgeye, I don't know how many of you have either used or are familiar with Hedgeye. Hedgeye is the research and strategy firm that was founded by Keith McCullough. Keith is, he's a former institutional guy. He was, working in the hedge fund business for a long time. He started that business. I saw with some interest that the way that they were making their bearish bets was in this complex, in the strategy complex of strategy stock and some of the ETFs that trade it and use options on it. Okay, so Sicilian Ambassador. Hi, Mike. What do you think are the most accurate market indicators that signal a change in market direction? A rally due for a correction, for example. Well, let's talk about the gold and silver area first. And I've said this on many occasions. To me, I've often felt that, and I think this is true probably for a lot of guys who, like me, traded commodities, that the thing you're really going to concern yourself with are the downside reversals. And this is I should really shorten this up so we can get a closer peek at what's going on here. What is a downside reversal? Downside reversal takes place when the underlying asset, in this case, silver, opens to new all-time highs and then closes sharply lower. And I think a good example of that is right here. And as you can see, it actually performed pretty well. It bounced off of that, but that was a really good and effective warning sign that there was something very much the matter. Let me get rid of these moving averages so we can take a closer peek at that. Also, the fact that it violated the 200 was, so I think there's an old saying, nothing good happens below the long-term moving averages. Do you use the 150? That's what my friend and colleague Carter Worth uses. And he certainly is a lot more seasoned at this than I am, so I will oftentimes look at the 150 as well. But because Bloomberg just defaults to the 50, the 100, and the 200, I often am just looking at those. And I don't know that it makes a huge difference in general to look at one versus the other. But this is what I really don't like to see. New all-time highs, rolls over to close sharply lower. And if I saw that, and the interesting thing is that I could see why somebody might be in this situation and say, oh, well, you know what, I don't want to take I don't want to take my money off, because that was actually a pretty big decline. In fact, actually, let's take a look at how big that decline was. And sometimes, folks will say, well, that's overdone. And it did prove to be. That was a 12, peak to trough, that was over 12%. And someone could say, well, that's overdone. Okay. Perhaps it is, perhaps it was. And what happened next is vaguely consistent with that. We can see that it actually rebounded by 11%. But that kind of price action is just not very healthy. That's quite bearish. So from my perspective, that's one of the biggest warning signs. Short term, as I just pointed out, I do look at the distance relative to the 50, just in general, to say, okay, are we overbought? I mean, we're not really, as far as the S&P is concerned, to my eye, right here. And actually, we have seen some broadening, which I think is healthy. But gold and silver, with those parabolic moves that they had seen, were 100% due for a correction, and they sure got it. Silver, didn't just correct. I mean, it fell directly into a bear market in a single day. That said, going back to the chart that we had here at the beginning, understand that whatever you're dealing with, where is this? This is the reality. Governments print money, and they cannot help themselves, and they're not going to stop doing it. So if you know that, then some of this other volatility, assuming you can stomach it, means that you still want to be invested in equities, and you still want to have an allocation to metals. Oh, what's interesting? This is something I think that's worth pointing out as well. So in one of our funds, we have GDX, we have SILJ, the silver miners, and we did have some GLD in there as well. We paired that last Thursday, which turned out to be pretty good timing. But that was not actually because of any technical indicator per se, despite the fact that the move in silver was looking quite unhealthy. The reason was because it was a rebalancing issue, which was that it had simply become too big a percentage of the fund. And the reason I bring this up is because, to a certain extent, one of the things that will make it easier to sell overbought assets inside of your portfolio is a simple system. So, for example, if you say, look, I'm not going to have more than 10% of the fund in gold, silver, or the miners for those two, then inevitably, when it gets above that, you're going to say, okay, well, we have to start pairing it. And it's interesting because that particular fund competes with some closely related funds. And one of the things that we observed was that they did not do that. One of the competing funds, I think their allocation to just the gold and silver miners was like 12.5% by the close of business Thursday. And when you consider that, the miners, and their business is very good, right? So it's all good. Things are working for them quite well. Silver, at its current price, it's still a great business. Make no mistake. And ultimately, I expect that the rally in these things will continue. But that's an important point. Consider pairing simply because it gets to be outsized of sort of the risk profile that you've decided is acceptable. How much is right for you? I mean, I would be kind of surprised if anybody thought that precious metals deserved more than 10% allocation or weighting in the portfolio in general. but definitely something to also think about. Finn West. Aloha, Mike. I recently rewatched the film Margin Call. I'm sure you've seen it, from 2011. How do you feel it reflected reality at the time of the 2008 financial crisis? Yeah, it's interesting because I was having this conversation with some younger traders when I was in Florida late last week. It's interesting because there were signs that things were very much the matter. But in many cases, unfortunately for me, I truly appreciated that only in the benefit of hindsight. Example, I had a family office call me up and ask me to meet them in late 2007 at their office. And they didn't even want me to get to the office. They met me on the sidewalk. So I walked down from our offices at 58th and Park Avenue down to theirs in the low 50s, and they were extremely panicked. They had just come from a meeting, and they had a lot of lockups. So they had invested in many hedge funds, and they couldn't redeem, so they were concerned about their equity exposure and were very concerned and wanted to hedge it. And they believed that the S&P was going to fall 80%. It did not fall 80%, but it obviously fell quite sharply. So that was a warning sign. I saw another warning sign when I was at a meeting at Lehman Brothers around that time, and somebody who was there that I was vaguely acquainted with was asking whether there were any job openings at Cantor Fitzgerald at the time. And again, this was well before the worst of it. This was still probably 2007. And that struck me as odd because from my seat, Lehman was doing pretty well as far as I knew. So I didn't really get to see the cracks that were emerging underneath the surface. And part of the reason for that is that on Wall Street, it's a funny thing, and people who've worked there can certainly confirm this, but you end up in a situation where a lot of people have both exposure and experience and knowledge that is an inch wide and a mile deep. And what I mean by that is that although there were a lot of issues going on in the credit markets, I didn't necessarily see that so directly because from where I sat, I was looking primarily at equities, equity options, index options, some other listed derivatives, but I did not really witness the cracks that were happening in the credit market as much as others might have. And the thing is, we were so close to it. There were a couple hundred traders on my floor. One floor down was fixed income. There's a couple hundred people down there. And that was just in that particular office. Cantor had offices everywhere. But, we didn't really see how bad it was. Not until I think a lot of others saw it as well. It was really mostly from seeing smoke from other firms. So if you think about it like this, in that movie, you have a bunch of traders and risk analysts who are saying, these securities aren't supposed to be moving like this. And since I wasn't looking at those markets necessarily, I didn't observe that part. But what I did see was how some of those firms began to trade with us in other areas. And that definitely was sending some warning signs. And at the very end, where Lehman Brothers, for example, is concerned, they were trying to do some trades, and we had some people in the securities lending business, who were becoming very alarmed about what they were doing and ended up effectively pulling their lines. So we knew at that point that there was real trouble, but I think everybody did. So I wish I had more insight than that, but from my seat, I don't think I appreciated just how bad it was, and but there were those that did. I heard from them, so I'm imagining that was reasonably realistic, except for one thing, and that one thing is that the timescales got completely compressed in that movie. It was as if a handful of guys at one bank figured out that the market was broken, and they dumped everything, and prices had fallen by 50% or something in that next trading day, the way they played out. In fact, the real time scales were much more extended than that. But otherwise, there were elements of it that were certainly realistic, and some of the other movies, like The Big Short, for example, which was based very much on real events with Steve Eisman and others. There was sort of a mixture. Some of it was dramatized, I'm sure, for the movie, but a lot of that was also real. Anyhow, because I have fast money today, unfortunately, I can't extend this as long as I normally would. So we're only 37 minutes in or so, but I'm going to have to cut this one short. Hopefully I'm going to have Mark Guthner back for office hours tomorrow. We're trying to work that one out. But at the very least, I will be back here with another open mic on Wednesday at 4:15 Eastern Time. Like, subscribe, and come back then. Thanks for watching.